Hello everyone. This is just a quick video on a major topic which everybody is discussing these days. The Indian market is cooked up. The Indian market is highly overvalued. The PE ratio is very high and all the stocks are trading at a very high valuations. So please sell all the stocks, get out of the market. A correction is here for a due. Let me tell you guys, one thing is for sure, whatever the people are talking about, the analyst is talking about, the every so-called market veteran or YouTubers is talking about, is about the market or the Indian market becoming overvalued. So what do you mean by this Indian market? Everybody talks about the indices, the Sensex, the Nifty, all those things. So those are all a group of top stocks or the stocks with a high market capitalization, or those are allocated into that indices. If you say that Nifty has gone up today by 1%, many times you must have seen that maybe your portfolio also goes but may not be in that same rate as Nifty. Say your portfolio may have dipped by 0.5%, or your portfolio may have gone up by 2.5%, even though the Nifty has gone up by 1%. So there is a disconnect between the indices and the portfolio you are having. So you may be having a highly concentrated portfolio on small caps, some on mid caps, and a few to large caps. So in that case, if the Nifty goes up majority, which is compiled of large caps, then if your stocks are more of small caps, you may not have that same rate change as that of Nifty. So if you see that Nifty PE is at 21%, maybe your portfolio PE may not be at 21% or something. It may be at 15%, 16%. Sometimes it may be at 25% also, or maybe at 30%. So that is subjective. So the whole point here is that the market overvaluation has many times has nothing to do with your portfolio performance. Your portfolio performance is based on the valuation of your stocks, the stocks in your portfolio, or whatever holdings you are having in your portfolio, whether it is overvalued. That we have to have a independent analysis of your own stocks. What is your price to book, price to earnings, your PEG ratio, price to earnings growth ratio, then your ROE, ROCE, your future projections, future earnings projection, what is your dividend yield, all those things. So there are a number of things you have to analyze for your portfolio stocks and take that call that whether your portfolio is overvalued. Yes, if the stock is so much cooked up, the valuations are too much stressed, then definitely you should consider selling it and booking some profit. And if the company fundamentals are good, then you can re-enter the stock on a later date at a lower valuation if your buying price is at a higher levels. If you have bought the stock very long back and if it is at lower rate, and if the stock is still overvalued, you can consider holding it because your buying price is much lesser. And even if the stock corrects, it is bound to go up because of the company fundamentals. So the point here which I wanted to say is that in a very short conclusive manner is that don't get carried away by the fact that people are telling that Indian market is overvalued. If you see the US stocks like Netflix, Apple, Amazon, everyone is having a very high PE ratio, above 25. So if you see with such overvaluation, the US market is still going up. So it is all based on your company fundamentals, your future earning potential, your future projections, how well the company is going to do. That is point one. And at what price you have already entered the stock and it has now become a multi-bagger is another case. But your entry price matters a lot. And if the valuations are stressed and if the earning projection is good, then if the earnings catches up, then the ratios or PE ratios or price to even the book ratio can go low and become attractive on a later date. So the valuation is something which you should really look at. It is subjective in nature. It is stock to stock specific, and you cannot generalize it based on the overall market valuation. So market is nothing but, as I told, indices. So Nifty is one thing, your portfolio is another thing. So if you are an index investor wherein you are invested in Nifty majority holding stocks, then yes, the Nifty valuations really impacts your portfolio performance. But if you have selected specific stocks which are maybe not part of the Nifty but are at a lower valuation, and the earnings is very good and the ratios are very attractive and it's a value buy, you have a factor of safety and you are having a high intrinsic value wherein the stock price has not yet reached that intrinsic value. So in that case, you are very safe in your investment, and even if the market crashes, your stock, or in that case your portfolio of value stocks, may not go down in the rate the market is going down or the index is going down. So don't be so much worried about the market noise of Indian market is overvalued. Just evaluate your own portfolio. If overvalued counters are there, just sell them if you find it is overvalued, and stay in some amount of cash. If you get a opportunity correction, you can enter into the same stock or even into other value stocks, wherein then the next rally can be utilized for creating further wealth. See you in next video. Till then, happy investing.